Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined for our annual podcast that we do by John Blank, Zacks chief equity strategist and an economist, to talk about what's going on in the economy out there. Will there be a recession in 2025? And we're bringing you some of our top picks for next year. So you want to stick around to listen or watch in on that because that's coming up towards the end of this episode. But welcome, John.
Tracey, good to talk about this always.
Yeah. So we have you on a couple times a year. It's been a couple months since you were last on. And when we talked about, whether or not there would be a recession, we concluded, no, we weren't in one. And it didn't appear that we were going in one, but we were going to regroup at the end of the year. And here we are at the end of the year regrouping. And so far, from what the data has told us, we are still not in a recession. Yes, I've learned enough from you over all these years to know we are not in one right now. But what is the data looking like? I'm still getting all these people on social media telling me, no, Tracey, you're wrong. Auto loans look terrible. Students aren't paying on the student loans. We have high credit card debt. We are in a recession, or it's coming in just a few weeks. But I know, and you know, that isn't what we look at to determine whether or not we're in a recession. So I'm bringing you on to enlighten us again on what do we need to look at? What is happening with the actual data?
Yeah, so Tracey, we got to lay out the usual strategy for people to discuss the same way every time, and that is, you have a civilian labor force in the United States of 160 million people, and it grows 1% a year, which means 1.6 million growth over 12 months, which is roughly 125 to 150,000, is, quote, break even. You have to do that much for the economy to be, adding jobs, above the population growth rate, right?
Mm-hmm.
Okay, so as we do with every show, and I've counseled, is the right way to get a signal from noise is to look at the 3 last months of data on the monthly non-farm payroll. We got the latest one on Friday, December the 6th, and I will just find the data for you. I've got it up right now. Total non-farm payroll employment for November was 227. I have September revised up 32,000 to 255, so it's 227 and 255. And October was revised up to 24 from 12,000 to 36,000, which of course we know was the Hurricane Milton effect. So in this context, Tracey, we really only have 2 numbers of value, which is the September number at 255 and the November number at 227. So under that scenario, relative to 150 and 125, we are double that break-even number of payroll growth. And that speaks for itself. People are growing this economy. If I turn to really the only statistic that should matter for people, which is real GDP growth rate quarter on quarter, third quarter, second estimate, 2.8%, and the fourth quarter estimate, which is getting close to being an accurate one, is 3.3%, which is consistent with payroll growth that's double that population growth. So from those 2 statistics, strong above trend long-term growth rate, real growth in the U.S. economy, and more than double non-farm payroll increases for the only 2 months we can look at, the most recent 2. There's no recession now, period.
Right. That's what I argue with the people who then try to look at all of these other factors, but those don't matter. The auto loans don't matter.
No, they don't, because they are not macroeconomic statistics. They can indeed be going up and down. but that is around the effect of the automotive market. And typically we're doing 16 or 17 million units. Last I looked, we were still doing them. And it doesn't affect enough households to drive a change at that high level. And if it did, we would start to see these non-farm payroll numbers and these GDP growth numbers reflect that. And we read these content, the non-farm payroll employment situation summary, the Bureau of Economic GDP numbers have 2 pages, people. You can go look at and read. And it does not speak to anything going on in the automotive sector that you should be worried about.
What do you think about the Fed continuing to cut? And at the time of this recording, they have not yet met in December, but it's most assumed they will cut again in December. But what do you make of that? The Fed easing a bit here, even with these types of employment numbers?
Yeah, so we've got a 2.7% core PCE rate in the United States, which is what the Fed cares about, 2.7%. So we've got a 4.6%, 6.4% Fed funds rate. We'll probably have 4.4% by next week. So 4.4 from 2.7 is basically, you can do the math yourself, 1.7% real interest rate. A real interest rate is what you pay above the core PCE rate, above the rate of price inflation. So if you're going to hold off and get a loan on these rates, you're going to get buying goods later on at that higher level prices. This is what the real rate of interest is. So typically the Fed likes a 1% real rate. So right now, let's assume they do cut next week, because they will. They'll be at 1.7%. So they typically like 1%. So in the absence of any movement down in the core PCE rate, which they expect to go from 2.7 to 2 by 2026. So 2.7 to 2 buys you 3 25 basis point cuts coming from slower inflation if it happens. The other 75 basis points are from 4.4 to 3.6, roughly. That's what they have in their September numbers for the summary projections. We're going to see December summary projections. So, we will need to update that number. But still, the same idea here is they have 150 basis points to cut from here if you count and throw away the December cut that's coming. And they had 75 or 100, that they can bring down to the real rate of 1% they like, and the other 75 or 50 is, basically more reduction in inflation if it happens. So that's the scenario. And, this is just them trying to do what's called normalize, to a core interest rate that is 1% above what they would hope to have, which is a 2% core PC rate, which is, then they get to 3%. So you can do the math yourself. 4.4% to 3% is basically 25 basis point rate cuts.
Okay. Are you, with all this in mind, are you bullish or bearish on 2025?
Well, here's the thing. I mean, we have a forward-looking 12-month valuation in the S&P 500 large cap index of 22. The 5-year average is 19. So again, you can get a 15% decline in stock prices just because we'll get back to the mean reversion of the last 5 years. So there's no question everybody should be prepared for a 15% correction. And the problem is that's going to muddy the water here, because as soon as that happens, Tracey, of course, the bears will say we're in a recession. That's a guarantee. So this is going to be the hard part here is, there is almost no question that within the next 3 to 6 months, we're going to get a 10 to 15% pullback, a really nice and big correction. And that will not indicate that we're going into a recession either. So this is going to be, again, you can guarantee we're going to have to do another podcast about the very issue at some point in time.
Right. I expect to have you on again next spring or so where we can discuss what's going on.
Yeah, absolutely. It's going to happen. People always think as soon as the stock market corrects, that it's going to have a massive effect on the U.S. economy. Again, why that's not the case, the propensity to consume, what's called the marginal propensity to consume, is 20 to 1 out of stock prices. I mean, 15% movement in down of stock prices, that is, 20 is like 3% change in people's amount of consumption out of that change in stock price. So very little change on that little change in wealth. And by the way, we had 2 really strong years of stock prices. So, discretionary spend is even in the face of that correction will be very strong. So it's always going to be, the typical problem of recency bias when people are going to be totally focused on the event of the correction and not focused on, the multi-year bull market run we've been in, the multi-year run the economy's been in, and the very unlikely case that we're going to run out of steam on this, at least in the next 12 months.
So you would see a correction as a buying opportunity then, it sounds like.
Yeah, I do. I think so. For 2025, I get more concerned about 2026. I think, there is a time where I would change my tune about that year. But this next year, no, I don't think I would be that concerned about a correction. I probably would be buying equity.
Let's switch to our top stock picks then, or just our picks for 2025, because that's what people are waiting for on this podcast. And I think the list is kind of interesting. I have 3 choices. You brought 2, but a lot of them are the large caps. Obviously, you run the large cap newsletter here at Zacks, so that makes sense. But all we heard all year long was small caps. And then after the election was done, the small caps had a nice rally, but they've given up a lot of it now. And so now we're not really hearing that much about the small caps once again. And here we are, you and I, picking stocks that are mostly mids or large caps. So what is your take on the small cap versus the large caps now?
Well, the problem we have here is we're in a historic period where we got 7 big companies making double-digit earnings from trillion-dollar market cap valuations. So they're just sucking a lot of the revenue life out of the entire economy. So I think, you got to be careful with small caps. I tend to like mid caps better than small caps because they track each other anyways, and they have real profits to go from. So if you know my market strategy report the last few months, I have been overweight mid caps because I think you get the same bang for your buck without having to get into the issue of whether these are just unprofitable companies and niches that are not going to grow.
That's a good point. Yeah. And you get companies that have been around a lot longer, I feel, for the mids.
Right. And that proves they understand a market niche that has sustained itself in this period with these Mag 7 names. Because I have yet to, get convinced that the zero rate environment of the last few years during COVID didn't just generate a lot of zombie companies. And they got, issued stock and they get put into the Russell, and or we got a lot of small regional banks. And, I tend to think that is not a very strong play when you have large cap and mid cap names that it can grow, and have strong profits in lieu of that.
Yeah. All right, let's jump into the picks. So we're going to start with what you wanted to talk about, and we're going to start with an interesting choice, I feel, but that is a little bit, like I said, just interesting. American Airlines, ticker AAL. I'm bringing it up on the screen for those who are on the video podcast. It is a Zacks number 3 right now, but it has an A VGM score on the style scores. And I've been kind of avoiding the airlines myself, but we all know that travel is still very hot right now. And these airlines are seemingly performing a little bit better than everyone thought they would at this point coming out of the pandemic. We're kind of done with revenge travel, but people are still spending, especially on those international trips. And American has big exposure to international routes. They're basically from the United States, one of the biggest airlines to Central and South America and the Caribbean. So why American?
Yeah, Tracey, let's just do magnitude of estimate revisions. Quarter 1, 88% upgrades. Quarter 2, 400% upgrades. The year 2025 plus 33%. year 2026 plus 10% to get to $2 a share, $2.10 a share. And buy this today at 1760. That's a PE ratio that's 10 or something like it, 11. And last earnings surprise, 131%. The average of the last four surprises, 124%. So looking at estimate revisions and surprises that are all triple digit, Tracey. And you've got a stock price that was $28 a share for, pre-COVID. You can do the math yourself. All that can happen here is we can get, I just saw last week a price target of 24, which is where our Zacks price and consensus chart say you should be by the early 2026, and markets are 12 months ahead of that. So this stock, might be a little pullback here because it's been running really strong from 10 to 16 to 17. But if you get in a nice 15 or 16 entry, you get to 24 or 28. That's in the next year going to be an outperforming stock.
Yeah, I put up the price consensus and EPS surprise. You can see the big earnings surprises that you were just talking about right there. And then this chart is, interesting because the stock is lagging what is happening with the earnings now. And I always look at these and think that these are, hidden gems, more value oriented stocks. The market's ignoring it, but it's actually executing, or the analysts believe it will be executing in this very good way. So this will be an interesting one to watch, I feel.
Yeah, the other thing we didn't bring to the table here, air transportation is 28 out of 250, top 10, 11% of our industries. And this is a major stock in that top industry. That's the tie-in you like. If you're going to track an industry, you want to track a big player, and American's certainly that. So there's lots of reasons, like any reason to buy a stock, you got to have lots of reason to buy it. Long-term scores are good. Surprises are good. Magnitude optimisms are good. Earnings are good. Industry is good. Really, what's not to like other than it's been running for the last 2-3 months?
Right. But you could say that about almost anything right now, other than energy.
Yeah.
It's the only one.
Yeah, and you get, how many stocks are offering you 10, 11 PE now after
right.
This is half. That's half 500, right?
Yeah, for sure.
So there's a ton of money that can get rotated into names like this. Just a ton of money.
Yeah. Okay, let's go with your next pick, which is MKS Instruments, ticker M as in Mary, K, S as in Sam, I, MKSI. I see it's in the electronics manufacturing machinery, but I'm not that familiar with MKS Instruments. So what do they do?
They provide, I'll just read it to you, instrument subsystems and process control solutions that measure, monitor, deliver, analyze, and power and control critical parameters of, quote, advanced manufacturing processes. So this is lasers, advanced manufacturing process for lasers, submicrons, RF and DC, ozone generation, control technology, residual gas. So there's all these scientific, very high-tech things that instruments are needed for, and this MKS Instruments provides those instruments. So it's a great stock to know about because it's not just one bet on one type of electronics company or chip. It's all of them. And this stock was $180 in the COVID period. It was $140, in the summer, and you can get in at $113. And I just love this chart where you can get in at 113, get to 140, where the fair value is right now. And you can keep running for another year to go all the way back to 180. That's a 60% gainer. So you get a number 2 rank. You've got last earnings surprise 21%. Average last 40%. Annual estimate growth 12-13%, and then 26 3 more percent. So you got to love the estimate revision chart, all getting upgraded over the last 2-3 years, showing strong growth, good valuation at 18 for a stock like this. High beta 165. So just if the economy and the stock market does well, there's your outperformance 165 in the beta. And then A for value, right? A for value. I just love stocks like this they're kind of been beaten up for 2-3 years, and you can get a nice entry point, and you can ride them back up again.
Yeah, this chart is fantastic on the earnings surprise. I have the price consensus and surprise chart up, and they haven't missed in 5 years. That's pretty rare now because of the COVID. A lot of companies ended up missing during the pandemic. Not surprising, but they didn't. So they've kept their streak. So it's a true earnings all-star here with all those beats. And then, as you mentioned, earnings estimates and the consensus up and to the right, and that's some nice earnings growth there for the next couple of years. That's what's expected. And the stock is not that expensive here. So this is one of the hidden gem type stocks, it appears.
Yeah, that's it. I mean, it requires you to understand a little bit about a complex business. But anything that's making $6.30 a share now and $7.50 a share next year, and it's $1.30. That's not, that's real money. That's real profitability. I mean, that's impressive. So, it's a name that I can't honestly say I've ever seen the brand because I don't participate in high tech, laboratories and stuff like this. But if you just understand the diversification of the business and it has a chart like this, you got to say it's not going to be able to come up with a bad story very easily.
Yeah, and it pays a dividend. It's not a lot, but about 0.8% is the yield. So they are willing to be shareholder friendly there. And this is one of the mid caps. This is a 7.6 billion market cap on MKS Instruments. But this is what I like about, the Zacks rank and using it. As you said, this is a number 2. So that's a buy stock, and the rank will will reveal these types of companies to us that we might not be familiar with. You don't ever hear anyone talking about it on, the TV shows or even much here on YouTube. I doubt many people are talking about MKS Instruments, but that's why I like the rank, because it can give us some of these stocks that are, executing well and are cheap in addition, but nobody's really talking about them. So that's always good. Okay, so those are your 2 picks, and we're going to switch over to mine. And one of mine, it really shouldn't be like a pick on a show like this, but I really can't resist. And I do have something new to say about it, and that's Amazon. So ticker AMZN. We all know the Mag 7. We all know their stories for the most part. Most of us own most of them, or at least some of them here or there. We own them in the S&P 500, or if we own the QQQs, we're owning them. We're going to own them somewhere. So why does anyone need me to tell them, hey, this might be a good stock for 2025? Well, people might not have noticed or heard about some of its new initiatives that they have rolled out in recent weeks here at the end of 2024. And some of those are, they're attempting to make their own chips for the AI. So that's a big deal. But they are also going into the chip data center services side of things. And it makes me a little nervous because I own some of the other services companies. And I'm like, Amazon might be getting into this end of the business. And what that is there is someone who has to make the racks to hold the chips in the data centers. And there are companies that are cooling the chips either through liquid cooling right now, or they have to cool the entire data center, which is like the air cooling systems, because these chips are very fast. They heat up. You don't want a fire or something going on in the data center. So you have to figure out a way to cool them. And Amazon is moving into this area now. And they're coming up with like new methods to cool the chips. And so I'm liking a company that is in many areas, and this is a new one for them, but there is growth there as we keep building the data centers. The chips are going to go in there. There is room to take some market share here. So that's why I like Amazon going into next year. They've also really fixed a lot of things that were going on the retail side, on the marketplace side. Some of it we don't like as consumers, but it's going to mean higher earnings for Amazon itself. Some of that is the ads that are on the Prime Video now. Yeah, I'm not a fan either. I am a Prime Video member. So I do curse it, but it is going to mean higher earnings most likely for Amazon. So little things like that have been tweaked. And the company is, doing much better on the growth side. And I'm scrolling down to show the price consensus and surprise. We see all these surprises starting in 2023. That's when they started the turnaround in a lot of their businesses. And that's really paying off. And then you can see on the consensus up and to the right, this nice growth that is expected over the next couple of years with a company that's already massive size. Like, this is not a mid cap. Obviously, it's one of the largest companies in the world, but yet still expected to grow, strong earnings growth here. Just looking down 2025, we do have another double-digit earnings growth expected, and double digits on the sales side for a company this size. That's impressive. You're not getting it cheap. It's at 44 times. It is at all-time highs here, but on some kind of pullback, like we've just talked about on this podcast, in the overall market, Amazon will pull back as well. It's done many pullbacks over the years. So if you're not in it, you might want to wait, get it maybe a little bit cheaper, but it was trading at 40 times recently, just a couple of weeks ago, and that is the cheapest on a PE basis that it's traded in decades, basically. So it's for its business, it's not that pricey, I think, here, and it's just got its hands in a lot of things, and it is executing, as we mentioned. What do you think about the Mag 7 stocks going into next year, John? They're at record highs, most of them, not all of them, but most are, and most are, not cheap. There's a few cheaper players in there that are in the 20 times on the PEs. But what do you think about them going in for next year?
Yeah, Tracey, large cap trader owns Amazon, it owns Google, and it owns Facebook. I've owned them for a long time here, last few months. They're the top of my performers right now. When you have names like this that dominate markets like this, you just got to put them in your portfolio. It's kind of obvious that they're just such big spaces in the U.S. economy and the global economy, and you got to own them because of that. And so, yeah, they're definitely ripe for a pullback, big time. But like we've talked about at the top of the show, a 15% pullback, 20% pullback in these names is exactly this place you want to pick up these names from. So I would tell you, you look at the chart, it's definitely way, way richer than it should be right now. But as a long-term call for 2025 on that pullback, this is the name you're going to look for to stick in your little spreadsheet that you're going to look at when that pullback comes.
Yeah, definitely. That's what I'm doing. I own it again in my own personal portfolio. But I'm waiting on the sidelines. I'm waiting to get that pullback. And so, because I do really like it for next year, and I probably will be adding to my position on any kind of pullback there, but we'll see. Me and everyone else might be adding. But there's always pullbacks. So, it is good to wait to maybe get it a little cheaper. Okay, my next stock is also on the travel side. It's not an airline like John brought, but it is Royal Caribbean, and it's ticker RCL. It is also a Zacks number 2 buy right now, and it has a sales score of A for the VGM. It's only a B for value because this stock too is looking a little bit overheated at the moment, but it's not that expensive given the huge run up that we've had. So it is trading now at 21 times. It was a little bit cheaper before this big rally here in 2024, obviously, but earnings are on the increase. And we all kind of know what's been going on with travel. But on the cruise line side, it has been red hot. And it was red hot going into this year, into 2024. And now we know it's red hot going into 2025. People book cruises 6 months or 9 months ahead of time. So a lot of the cruises are already sold out for, next spring, next summer, but even next fall. And Royal Caribbean said even bookings into 2026 now are very healthy. So another issue is a lot of these cruise companies, they built a bunch of ships a number of years ago, but now they haven't been building the ships. So they're kind of at capacity, and that does give them some pricing power because no one else is building one of these new big boats. And it takes a couple of years to build one. So they can't really add new rooms, new ships with the rooms. So if you want to go on that one cruise, you are going to pay to go on it. And people are willing to pay right now. And this is a big cap, 66 billion market cap. It does pay a dividend, but it's small, just 0.7%. But like I said, trading at 21 times, I still think there might be some more room to run here in 2025. That consumer is strong. The job market is still pretty good. The stock market's at all-time highs. A lot of baby boomers are deciding, hey, my stocks are up. Let's go take that once-in-a-lifetime cruise we wanted to do up to Alaska, out over to Europe, to the Caribbean. We want to do it, and we're going to do it now. So I still think there's a good room for further gains next year, but I would be waiting on the sidelines for a little more pullback in this one because it is at the all-time highs. It has been red hot just recently after the election, and I do think this one is going to be pulling back the 10 to 15% in a bigger market pullback, and that will be a very attractive buying opportunity on Royal Caribbean. So that's Royal Caribbean, ticker RCL. Do you own any of the other travel names, John, in your large cap portfolio other than like the airlines?
No, I don't actually.
Okay. It is hard right now, I feel, because they've had these big runs. I look at a lot of the hotel companies, and I'm interested in what they're doing too, because I do think they are taking some market share back from like Airbnb or Vrbo. But those shares have really run as well and are now trading, 30 to 35 times forward earnings, which is pretty pricey for me.
Yeah.
Yeah. Okay, and I want to wrap it up with an unknown name, one I talk about that just kind of gets ignored by the street. It's had a big run too, but it's been in an area that has been really challenged in 2024, and that's Ryder System, ticker R. I own this one in the value investor portfolio. It's only a number 3 right now, but it does have the A style score for the VGM. And it's got the A for value. And this is one of the few stocks that's had the big rally. It's trading near its all-time highs, but yet it's still attractive PE at just 13.7 times here. And so what's going on with it? It was kind of left for dead during these, little bit post-pandemic years. It went sideways, and now it's finally moving up, but it has been challenged on the earnings side because there's been a freight recession over the last about 2 years now, 2023, 2024. But freight is starting to come out of that now. Finally, the recessions only last so long in these individual industries. We're finally seeing some light at the end of the tunnel on freight, and Ryder also big on logistics side, but that side will start to improve as well. And so the earnings picture is looking a little bit better. And you can see that on the chart. We have some earnings growth expected now after kind of a negative year here for 2024, but some nice earnings growth for 2025. And then 2026, the analysts are looking even more positive. So I like the areas that are coming out of recession, which would be some manufacturing, housing, the furniture retailers, for instance, and then on trucking, freight, logistics. this side been very challenged, and these stocks are cheap. So they have a market cap of about 7 billion. So they're a mid cap. They do pay a dividend yielding almost 2% right here. They are very shareholder friendly because they're trying to keep you around in the stock, but now the stock's busting out to new highs. So you kind of had the best of all worlds. You have a cheap stock. It's finally turning those earnings around for next year, it looks like, and you're getting the dividend as well. So I like these areas, and Ryder is one that almost nobody's talking about anything going on the freight side. And rightly so. It's been very difficult, and it has been what the industry even calls like a depression over there. There's been a lot of layoffs. There's been bankruptcies. Yellow Trucking went under a couple of years ago during this period. And so it's finally seeing the light at the end of the tunnel. And if you have survived it all, which Ryder has, then there's going to be a real opportunity there. So they're preparing for it, and we'll see. We'll see what it does in 2025, but I'm liking the outlook there. And this is another one that if it pulls back 10, 15% off these highs in a bigger market pullback, it's even better. You're getting it even cheaper. So I would definitely be a buyer on a 10 to 15% pullback. Okay, so these are interesting, John, because we're looking at a lot of different areas here. Like we didn't focus on just one industry, and they're kind of in industries that, have been disregarded, I feel, by the market to some extent, other than Amazon. But, the others, in the air transportation and the airlines, and everybody's in on the cruise story now. I guess that's one that has been popular, but the others not so much, even though the stock charts have said otherwise. But just in terms of interest by investors, the mom and pops out there, we've all kind of been on the sidelines on a lot of these plays because we've been focused on the Amazons and the Mag 7s, but there looks to be a lot of opportunities with attractive valuations on a lot of these other stocks. Yeah. Okay. So let me recap the stock tickers again. For those of you, in case you missed it, we had American Airlines, ticker AAL. We had MKS Instruments, ticker MKSI. We had Amazon, ticker AMZN. We had Royal Caribbean, ticker RCL. And we had Ryder, which is just ticker R. That tells you how old it is. It's got the single ticker there, which is kind of prestige, but ticker R as in Robert for Ryder. And as always, I'm bringing you stocks all throughout the year. We're going to take a little bit of a breather coming up at the end of the year, but I still have one more episode I'm going to be putting out on the Market Edge of the best of the Mag 7 stocks. They're not all the same. I have my favorites for next year. I already included one of them here. Maybe this will be on that episode too on Amazon, but be sure to tune in to get that episode. And then we will return in the new year, and John will return back next year too to give us an update on what's going on in the economy. And so you don't want to miss a single episode. I know many of you are subscribing here on YouTube. Make sure you are subscribed. Make sure you are liking our podcast here. And if you have ideas that you want to hear for next year, I aim to please, as you know, many of you have already posted ideas, stocks you wanted to hear about in the comments. So do that on this episode. I'm taking a look. I'm reading all of your comments, and I will try to incorporate some of those into next year for our podcast in 2025. I'm excited. I know you are, but I will see you then. Make sure you subscribe if you're not on YouTube. Get us on audio. We're on Apple. We're on Spotify. I know many of you are over there on Spotify, and I thank you for listening. But otherwise, tune in for our final episode. We got one more coming, and I'll see you next week with some more stocks.